In January 2019, WeWork was valued at $47 billion, more than Ford, more than many established banks. It was the future of work, the future of cities, the future of community. 9 months later, its valuation collapsed below $10 billion. Its IPO was cancelled. Its CEO was forced out. Billions in investor capital evaporated. 4 years later, WeWork filed for bankruptcy. This is how one of the most hyped startups in the world unraveled in real time. Asset 1, the hype machine. WeWork did not start as a real estate company. At least that's what it insisted. It started in 2010, founded by Adam Neumann and Miguel McKelvey. The idea was simple: lease large office spaces, redesign them with glass walls, exposed brick, polished concrete, sublease desks and offices to startups, freelancers and small teams. But Adam Neumann did not sell desks. He sold a movement. He talked about elevating the world's consciousness, about community, about transforming how humans worked and lived. WeWork wasn't a landlord. It was a technology platform, a lifestyle brand, a revolution. Investors listened. In 2017, SoftBank's Vision Fund, led by Masayoshi Son, poured billions into the company. SoftBank didn't just invest, it supercharged WeWork's valuation. By 2018, after multiple funding rounds, the company was valued at $20 billion, then $30 billion, then $47 billion by early 2019. The numbers were staggering. WeWork expanded at breakneck speed, from one building in New York to more than 800 locations across 120 cities worldwide in less than a decade. It leased millions of square feet in Manhattan, London, Shanghai, Sao Paulo. Revenue surged from $886 million in 2017 to $1.8 billion in 2018. Growth above 100% year over year. But beneath the growth was something else: losses. In 2018, WeWork lost $1.9 billion, nearly matching its total revenue. The company was burning cash at an extraordinary rate, yet the narrative overpowered the math. Neumann positioned WeWork as a tech company. Tech companies receive tech multiples, high valuations justified by future scale, network effects, platform dominance, but WeWork's core business was leasing office space, a capital-intensive, cyclical, low-margin industry. Still, money flowed in. SoftBank alone committed over $10 billion across equity and debt. The Vision Fund treated WeWork like the next Amazon. Neumann expanded beyond offices. We live, we grow, co-living spaces, private schools, residential communities. It was ambition without restraint, and investors kept applauding. ACT2, the cracks. The model looked elegant in presentations. Sign long-term leases with landlords. Renovate the space. Sublease it to members on flexible terms. Capture the margin. In reality, it was a structural mismatch. WeWork signed leases lasting 10 to 15 years, sometimes longer, fixed obligations, billions in future rent commitments, but it rented desks month to month. If tenants left, revenue vanished. Lease payments did not. By 2019, WeWork had over $47 billion in long-term lease obligations. That number was rarely highlighted in early headlines. Occupancy had to stay high, constantly, across hundreds of buildings worldwide. During economic expansion, that was manageable. But what happens in a downturn? The business had no insulation. No recurring contracts with long lock-ins. No proprietary software generating high-margin revenue. Just real estate commitments. The more WeWork grew, the more it locked itself into fixed costs. Expansion required upfront build-out expenses. Renovations were expensive. Marketing was aggressive. Corporate overhead ballooned. The company's adjusted EBITDA losses were presented as temporary. Growth justified the burn. But growth was fueled by capital, not profits. By mid-2019, WeWork had burned through billions. It needed the IPO not just for prestige, but for survival. The hype machine required fresh oxygen. And then came the filing. AT3, the IPO disaster. In August 2019, WeWork filed its S1 to go public. The document was meant to inspire confidence. Instead, it triggered alarm. Investors saw the real numbers: massive losses, negative free cash flow, thin margins, enormous lease obligations. They also saw something else: governance chaos. Adam Neumann controlled the company through super voting shares, giving him outsized power. He had borrowed hundreds of millions against his stock. He personally owned properties that WeWork leased from him. The company paid him millions in trademark fees for the word "we." The S1 described the business in abstract language about energy and community. It read more like a manifesto than a financial disclosure. Public market investors were not impressed. Analysts began questioning the $47 billion valuation. Comparisons to tech giants dissolved. WeWork looked less like a platform and more like a leveraged real estate operator with no profits. Private market enthusiasm does not always survive public scrutiny. Within weeks, valuation expectations fell from $47 billion to $30 billion, then 20, then below 15. Some estimates suggested under 10 billion. The drop was brutal. SoftBank, which had marked its investment at sky-high valuations, faced mounting pressure. Institutional investors signaled they would not buy shares at the proposed levels. WeWork delayed its IPO, then delayed again. Confidence evaporated quickly. Contrast is what made it shocking. Months earlier, Neumann was on magazine covers, the next generation of visionary founders. Now he was being compared to cautionary tales. The market had spoken. AT4, the fall. By September 2019, the IPO was officially withdrawn. WeWork was running out of cash. Without public funding, it faced a liquidity crisis. The board acted. Adam Neumann stepped down as CEO under pressure. He retained significant shares, but lost operational control. The charismatic founder who promised to change the world was sidelined in less than a month. SoftBank orchestrated a rescue. In October 2019, SoftBank announced a bailout package worth roughly $9.5 billion in new financing and tender offers. The deal effectively handed control of WeWork to SoftBank. Neumann exited with a controversial payout reportedly worth over $1 billion, including stock sales and credit facilities. Employees were not so fortunate. Thousands were laid off. Expansion plans were halted. International growth slowed dramatically. Non-core ventures were shut down. The company that once symbolized boundless expansion was now cutting costs to survive. And then, in 2020, the pandemic hit. Global office demand collapsed almost overnight. Remote work surged. Companies reassessed long-term office commitments. Flexible space sounded appealing in theory, but economic uncertainty reduced occupancy. WeWork's vulnerabilities intensified. In 2021, the company finally went public through a SPAC merger at a valuation around $9 billion, a fraction of its peak. The hype was gone. Losses continued. By 2023, WeWork filed for Chapter 11 bankruptcy protection in the United States. Billions in investor capital had been wiped out. From $47 billion to bankruptcy in less than 5 years. The speed was staggering. AT5, the real reason. WeWork failed. WeWork did not collapse because people stopped needing offices. It collapsed because valuation drifted too far from economic reality. The company positioned itself as a high-margin technology platform. In truth, it operated a low-margin, asset-heavy real estate model with massive fixed costs. Growth masked fragility. As long as capital was abundant, losses were tolerated. Cash burn was reframed as investment. Scale was equated with inevitability. But scale in a structurally weak model only amplifies risk. WeWork's long-term lease obligations created financial rigidity. Revenue volatility met fixed commitments. That mismatch was not a temporary problem. It was embedded in the design. Leadership amplified the risk. Adam Neumann's vision attracted capital, but governance failures undermined credibility. Conflicts of interest eroded trust. Super voting control structures insulated leadership from accountability. When scrutiny arrived, the story unraveled quickly. Public markets demand clarity. They reward profits, or at least a credible path to them. WeWork offered neither at scale. The deeper lesson is about the era it emerged from. The 2010s were defined by cheap capital. Venture funds chased growth. Unicorn valuations soared. Narrative often preceded profitability. WeWork became a symbol of that environment. It convinced investors that a conventional business could be rebranded as technology and valued accordingly. For years, that worked. Until transparency forced a reckoning. Valuation is not value. Private funding rounds can inflate perception. Public markets impose discipline. When financial statements replace pitch decks, illusions fade. WeWork's collapse was not a single event. It was a chain reaction. Structural weaknesses, governance failures, excessive leverage, overexpansion, all exposed by scrutiny. $47 billion in January 2019, under $10 billion by the end of that year. Bankruptcy within 4. The offices still exist. The desks still exist. But the myth is gone, and the lesson remains. In bull markets, stories can overpower numbers. In the long run, numbers always win.